Hello, everyone. Today on the final bar, we will do our normal Monday routine. We'll look at the market from three directions: top-down macro, bottom-up stock picking, sector rotation. We'll look at all the themes playing out. I feel like this one day had a little of everything. You have the cyclical sectors like energy, financials up pretty decently, had a pretty good day as rates go higher. Tech, communication services down, but the S&P going into the red right into the close. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment. In this shortened holiday week, we look at how stocks are changing. Usually, a holiday week tends to be a little lighter volume, usually flat to positive, although looking at the Stock Traders Almanac earlier today, edited by Jeff Hirsch, talks about how Thanksgiving week actually has mixed results. Used to be pretty safe that you could, buy in the strength of this week by Wednesday usually and sell on Friday, but it's not really necessarily the case anymore. What they're saying now is basically the whole week tends to be a little bit higher, and then you sort of roll over into the week after. We'll have to see how the charts actually play out. And today, not a great read into the end of the session, where the S&P had spent most of the entire day in the positive, just accelerated to the downturn. And he had a little bit of news flow here, minor news flow, like Powell getting renominated for another term as Fed chairman, minor issues like that certainly have implications across the financial markets, but a good dose of distribution going into the close. This market has all been about the leadership rotation, right? And I think the story of 2021 is less the fact that the averages have gone higher, but more what's been driving it. And on a day like today, you have a lot of growth stocks that have had good runs, pulling back a little bit, financials bouncing off of support, energy as well. We'll get to as many of those charts as we can. We have great guests on the show. A lot of fun to review some of the old discussions that I've had. You can go to our on-demand platform, also our YouTube channel to check out any of the previous interviews. Tomorrow, we just have one guest this week, Mike Siccardi, who just joined StockCharts.com as a columnist. He's writing some content for our Top Advisors Corner, particularly for financial advisors. Does a really good job of making the market seem very simple and very straightforward. We're going to take Wednesday, Thursday, Friday off for the Thanksgiving holiday, and I wish you all a very, very good Thanksgiving break. We'll come back with you the Monday after, and that Tuesday, the 30th, we'll have Sean McLaughlin, the options strategist at All Star Charts. Let's continue on our market recap. As I mentioned, again, it's my bad. Anytime I try to prepare just a little ahead of time for the show, I always joke with my wife that I usually do a lot of the prep in the hour leading up to it. I'm grabbing lunch and then spend some focus time getting ready and thinking through some of the key charts based on what I've looked at through the course of the day. And I'm kind of taking notes during the course of the trading day. But this is one of those where I break to actually pick my son up from elementary school, grab a quick bite to eat, and I come and sit down and everything has shifted. So that's fun. But the S&P finished the day down 1/3%. That's after touching 4740 out of the open in the first hour of trading. We're now back below 4700. So that 4700 level is actually an interesting one that keeps, seems to keep coming up as we look at these markets, right about where we closed on Friday. And now we got back below there again today. The NASDAQ down even further with the NASDAQ composite down 1.25%. Now, this spent most of the afternoon below zero, came back to test Friday's close, and then just rotated right to the downside to sell off. The VIX, given the weakness that you saw today, uncertainty increasing means the VIX increases back around 1940. Mid caps and small caps positive for the day. The story here, at least one of the stories, interest rates going higher today. And when that happens, two things you can assume are probably playing out through the course of a period like this with higher interest rates. Number one, stronger financials. Number two, weaker growth stuff like technology. And that's kind of how things played out today. 10-year yield finished Friday just around 153, 154, ended the day today above 162. So you're seeing a rising rate environment. We've talked about that overall environment. We talked about how last week you had rates coming off, and that's when you saw the growth trade start to really work again, and things like energy, financials pulling back. One day like today, and you see how quickly that those tides can shift. It's a great reminder to me that interest rates are the most important chart to focus on right now, besides the chart of the S&P. I think that's number one. The second thing is to really think about the short-term movements versus the long-term. My long-term sort of base case is that we're seeing a rising rate environment well into 2022. And I think that has potential tailwinds for financials and cyclicals, potential headwinds for the growth stocks. While that didn't play out last week, you're certainly seeing it play out today. The dollar index, by the way, continuing to push higher, should be a nice tailwind for small caps for sure. Looking at commodities overall, sort of a mixed message in general from the commodities complex. The energy stuff was up positive, which is why the XLE, the energy sector, up 1.8%. Gold and silver actually down, along with copper, which is not a precious metal, more of an industrial metal, but sort of flat for the day. Gold and silver coming off there. We talked about that rotation higher in the GLD, and I still see that as something we'll be paying attention to. It's interesting today to see rates going higher, which implies inflationary concerns increasing. That tends to coincide, but gold not really playing out to that reality. Cryptocurrency is really feeling the pain today. And as we mentioned, this is a volatile space. So if you enjoy volatility and uncertainty, there's a lot of fun to be had in cryptocurrencies, particularly the altcoins, the smaller, less liquid coins, where there are lots of huge percent swings to the upside or the downside. But I'm concerned about the chart of Bitcoin. Actually touched 60,000 from below over the weekend. This was overnight here Eastern time, and then sort of rolled over and really accelerating to the downside as we're doing the show today, Monday afternoon. Bitcoin, Ether, and all the other major coins that we track. We have about 160 coins that we have on our platform at this point, but the top 10 are listed here. You can see all 10 of them in the red. Let's continue on with the chart of the S&P 500. So a bit of what's called a bearish outside day. Candle pattern, there's not really a clear candle pattern here, to be honest with you. I don't know if I could call it anything in particular. It's not a bearish engulfing pattern because it's not the right configuration or anything, but it would be considered, I would argue, a bearish outside day. That's where, in bar chart land, that's where the range of day two exceeds the range of day one. So higher high, lower low, which we've had, and it's a distribution day where you close below the open. And so that's a short-term negative signal. So if you look at what's happened, right, is the S&P's rallied up in the first week in November, pushing up to 4,700. From there, it's really stalled out. And while we tested 4,750 earlier today, we closed back below 4,700. So it certainly seems to me like 4,700 is the new line in the sand, the new level of resistance, not based on any, chart resistance, because we're in uncharted territory, pun intended. We're at new all-time highs. So at this point, you just have to see what the market tells you in terms of where. Now, there are concepts, there are techniques to try to project levels to the upside. I don't use a lot of those in my own work, so I tend to follow the trends and look for signs that the trend is no longer persisting. A level of resistance that the market is unable to eclipse is the beginning of that potential sign. So 4,700, clearly a level to pay attention to here in this shortened holiday week. 4,550, absolutely the most important level, I would argue, on the downside, because that's the high from early September. That's where we broke out in mid-October, and that's right about where the 50-day moving average is going to be over the course of the next couple of weeks. So remaining above there, and the long-term trend is still very positive. Breaking that sort of level, we are going to talk a lot about some of these other shaded areas that are well below the current market, but would get closer and closer if we continue downwards. I mentioned cryptocurrencies. I'll show you a couple charts here. Bitcoin is one, and the general thesis that I was explaining, or that I've mentioned probably when I've brought this chart up, is you have these big blue lines which represent bearish momentum divergences. You've had a number of these in 2021, and the first two times, two things happened. Number one, you indeed went lower eventually. Number two, you did make a higher high in both of those cases. And that's why I sort of said it's a tentative distribution pattern, because we keep making higher highs. Now, the key with any sort of momentum divergence is breaking the low, right? So when you look in August, right, the low between these two bearish divergence highs, if that's a way to describe it, is here in mid-August. We bounced off of there and then broke it, and that's really the signal that things are really getting negative. You see the same thing here. Breaking that level of support is a real validation of the downside, just making a lower low. What's interesting is we've already made that lower low, right? We broke below the 50-day, tested that from below, and now so far rolling downwards. So overall, it certainly feels like this is a chart in distribution mode. From a long-term perspective, you see an asset class or a chart that's gone from a huge retracement, right? A 50+% drawdown from April to June, and then 100% recovering those previous highs, but really not following through to the upside. We got a couple thousand points above the April highs, but really didn't follow through. They really didn't validate that with enough further upside. So overall, this certainly seems to be a chart showing weakness. The bearish momentum divergence is a concern. Breaking swing lows is a concern. Breaking the 50-day moving average. All of those things line up to suggest a chart that's weaker rather than stronger. Gold is a tough one. We talked about this 170, 150, 172 range. This is that pink shaded area. It's the first Fibonacci retracement level. So important that we get above those highs. We gapped above them. Today, we actually gapped right down below it. So I have to tell you that this would mean that this bullish thesis of the market of gold just going onward and ever upwards certainly appears to be in danger. Now, looking to see if it can hold support levels is pretty important. Can it make a higher low? All of that is very, very valuable. This is what's actually called an island reversal. We have a gap higher, you spend some time up here, and then you gap down. Think of it like you're looking straight down at a map, and you see this little island. That doesn't tend to be good when it happens after a gap higher and then a gap lower, and you want to see it regain that 172 level to invalidate that short-term bearish thesis. But both gold and cryptocurrencies altogether sort of showing some short-term weakness, I think lines up with some of the long-term challenges that we've talked about for quite some time. Let's continue on with our next segment called Sector Setup. So we talked about the big picture, the strength in stocks, and again, overall, a bit of a distribution today, but the long-term uptrend still very much in play. 4,700 is a key level for the S&P and 4,550 below where we're at. We talked about the weakness in gold, precious metals, and cryptocurrencies, particularly Bitcoin, although there are many other examples that we could certainly talk through. Let's now look at the 11 S&P sectors and how they are trading. We're going to start with the RRG, the relative rotation graph. This is something Julius de Kempener designed years ago, and I'd encourage you to check out his show, Sector Spotlight. If you don't understand this methodology, it's very well designed and just has so much information in a quick visual. And what we're doing is looking at the 11 S&P sectors, how they're rotating around the S&P benchmark, which is the crosshairs, the 100 line right in the middle. And then up and to the right means it's outperforming with improving momentum. Down and heading to the left means it's underperforming with accelerating downward momentum. So what are the weakest charts out of all of these? It's all of these ones in red that are heading southwest, right? Real estate, healthcare, communication services, utilities, staples. And let's start with communication services. And I'm asked about that sector sometimes. And just thinking about how to, how should we rotate in and out of it? And I will tell you that the problem with the communication services sector, it has some really good stuff and some really bad stuff. So you have AT&T and Verizon, which granted bounced a little bit today, but overall are just ugly from a technical perspective, just continuing to underperform, weakening price, weakening momentum. At the same time, you have things like Alphabet, which are pretty close to all-time highs, resilient uptrends, so things like Facebook pulling back, but then rotating back to the upside. And then you have things like entertainment names, Viacom and Discovery, Disney, which are all fairly negative from a technical perspective. So it's a real mishmash of things. And while you have some mega cap names, I think any of the glistening that you've seen on the chart of the XLC, that sparkle that tells you should think about it, are probably those mega cap names that are enough to hold it up in a legitimate level. But the fact that it's going down into the left shows you how weak all those other stocks really are and how that's sort of compounding the negative trend in communication services. In terms of improving places, two sectors to mention, materials and industrials. Those are both in the improving quadrant and heading northeast. It's what I call the direction of improvement. That's actually an encouraging rotation higher. So still underperforming, but you're starting to see some signs of strength. And again, in either of those sectors, I don't have any trouble finding some charts that are fairly meaningful. Just like in communication services, it's not hard to find pretty good charts and pretty bad charts. The same could be said for something like materials. Same could be said for industrials. Some trucking companies, I would imagine, or like business support services, if I remember right. I'm trying to think of what that one group is, doing very, very well. Things like Vulcan and what else would be in that group? I'm blanking. There are a number of charts that are pretty decent. We'll get to that if I could remember after the break. Now, the rest of these, as you can see, are pretty strong. Three sectors to highlight over here. Number one, energy, which has had a pretty significant run. Now, a lot of those energy stocks have come off. We talked, and we may have talked, and if not, I apologize for that. Things like Chevron showing a bearish momentum divergence potentially. But overall, these are charts that have had pretty good runs, pulling back a bit. Now, today, you're starting to see those bounce a little bit. And the question is I think, for all those charts, is this the beginning of something further? Consumer discretionary certainly showing some strength. And it's a lot of different groups showing some renewed upside there. Things that come to mind are like Ford and GM with some improving charts there. But the most important one I could probably highlight out of all these is technology. Now, my general thinking is that in a rising rate environment, growthy sectors are going to struggle and value-oriented sectors are going to do well, which is why the energy or financials play seems pretty interesting. Things like consumer discretionary and technology seem a little more challenging. However, the charts are telling you that there's still plenty of strength there. And when I look at semiconductors, I'm seeing quite a diverse group of charts, but I'm seeing some really good charts that are breaking out just fine and aren't having any trouble anytime soon. So again, I would always remind you, don't think about what should work in a particular environment. Focus on what is working. Focus on the charts that are working. There could be a scenario where some of these cyclical sectors and technology end up doing very well, and all these other sectors tend to struggle. That's certainly a possibility. And then later, we'll all debate why technology did so well when rates are going higher, but it can certainly happen. So make sure you're focusing on the charts. And again, in these sectors, I'm certainly finding some things to be impressed about. Now, when we look at the 11 S&P sectors on the candle glance page, a couple things that jump off for me. And, again, I'd encourage you to look across and see what stands out for you. The two things that I'll highlight, then we have to break. Number one, communication services hitting its 200-day moving average. That is the only one of the 11 S&P sectors really anywhere near its 200-day moving average. That tells you why it's the weakest chart on the RRG, and that tells you why most likely I don't think that's a great place to be until you see signs of improvement, also testing those lows from October. Second one is energy, and you can see the chart of the XLE has had a really good run. Now it's testing its 50-day moving average from above. When we get in our next segment, we'll look at a couple of the charts that are very similar setups to this that show you how this sector has actually pulled back, potentially setting up for the next big leg higher. Let's take a quick break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close for our show. A couple quick announcements before we get to our next segment on the show. Number one, we would love to hear from you. We're going to do a mailbag segment on Tuesday of this week, and we would love to answer one of your questions live on the air. You can get your questions to us one of three ways: via email, which is the best, thefinalbar@stockcharts.com. On Twitter, just tag us in a comment at FinalBarSCTV. On our YouTube channel, put a comment below the video that you're watching. We'll review all of those questions. Hope to answer yours on the air on Tuesday's show of this week. Finally, go to StockChartsTV.com. This is our on-demand platform. Last week, if you missed our special on Chart School, focusing on the chart lists capabilities, really well done. 5 really great, good presentations. Julius DeKemper, I think, did a great job on Friday with that one. You can access those along with special shows like The Pitch, regular shows like The Final Bar and others, and our year-end review and so much more. StockChartsTV.com is the website to go to, or on your mobile device, just search on any of the app stores for StockCharts TV on demand. Our next segment is called Shifting Stocks. This is where we complete our 3-pronged approach to market analysis. We talked about the big picture with the S&P not far off of all-time highs. We talked about sector rotation, the strength that we've seen in energy pulling back to the 50-day moving average, renewed strength in consumer discretionary and technology, emerging strength potentially in some of the other cyclical sectors like industrials. Finally, let's look at some of the individual charts that I think are worth noting. And again, this segment, it's laughable that we only have like 5 or 6 minutes most Mondays to go through this, because there are thousands of charts we could look at any point. But my goal is to just give you a little idea of some of the potential themes to pay attention to. We're going to start with payment processors. We're going to jump right to technology, because usually I actually start alphabetically and I rarely get all the way down to tech, or if I do, I'm scrambling at the end. So let's flip it over and start there. Charts I'm concerned about it's this entire group, right? And these are actually in a couple different groups, if I remember right. They might all be in computer services. We'll see here in a second, but Square down 6% today. And again, the lower high is concerning, lower low now is concerning. The RSI in the bearish phase really didn't, really February was the peak, right? Hit a peak in February, tested it again in April, tested it again in August, but has never really followed through on there. And that's why when I bring up charts and I talk about its testing resistance and you'd really want to see a breakout and follow through, it's to avoid things like this in early August. If you get all excited when a stock is gaining, and regaining those all-time highs and you think, perfect, this is the time to get in, if it doesn't have enough momentum to get above there, people are just exiting and taking profits there, and you're, anyone that bought at that end is completely underwater now. So, the reason we wait for the breakouts is to confirm that something like this is not happening. And payment processors overall struggling. This is what Square looks like in those same similar types of names. You have Global Payments, GPN, which is probably one of the worst out of all of them. PayPal, though, pretty close. And again, this is just a chart in full-on distribution mode. Again, February high, July high, never got above there. That's a problem. Lower high is also a problem. Breaking all the moving averages is a problem. Getting below, everything just keeps kind of failing. It's below its first Fibonacci support level as well. And then you also have the big names in here like Visa, which looks like that, and MasterCard with a big down move today. So all of these are breaking support. We've talked about them for quite a while. So I hope you've been following along and seeing these rotate from accumulation phase to distribution phase. That's the type of rotation we want to capture and get out of the way of and avoid holding these things. Because what happens if you hold a name like Visa or MasterCard as it's going down, PayPal as it's going down, it's called the endowment bias. Just because you own it, you justify holding on to it long after the chart tells you to get out of it. Next, I'm going to jump to kind of an interesting place. Actually, no, let's talk about energy a little bit. We talked about the XLE, which looks kind of like this, pulling back to the 50-day moving average. This looks a lot like the chart of, CVX maybe? Nope. COP. One of these. Yeah, ConocoPhillips. I was going to say one of these almost looked identical to that. It's what a lot of the energy names look like, right? You broke out September into October. We've had about a month, 4 to 6 weeks of pulling back a little bit, but hitting an ascending 50-day moving average. Nice rotation higher today. My question through the rest of this week into next week and really through year end, you get that renewed push higher. And I think bouncing off of an ascending 50-day moving average is a pretty decent place to start. I wouldn't feel bad about making an assumption that that's kind of going to work. In terms of overall charts in this sector that are setting up the best, Devon Energy, DVN is a good one. FANG overall pretty well and pulling back to its 50-day moving average. We talked about ConocoPhillips as well. On the DVN, as well as the chart of CVX of Chevron, if there's a concern I have about this sector, it's some of the bearish momentum divergence you've had. Some of these stocks that are actually holding up really well, like DVN, it hasn't even made a new swing low necessarily, depending on how you think about this, is making a bearish momentum divergence. Most recently, you're going higher on less momentum October into November. Now, that really doesn't trigger as a negative signal until you start breaking down support levels. That's what I'd be looking for on DVN, but overall, a strong trend with a nice, strong performance run up until now. I'm probably going to give the benefit of the doubt to that sort of working. Now, as energy's working, you also have some renewed strength in places like financials. TROW reminds me of the charts of PayPal and others where I mentioned, approaching resistance, not quite breaking out. And that's why you need to wait. Something like TROW really hasn't given that breakout signal yet. Like it's retesting the previous highs. I'm finding that in a number of the charts in the financial sector. So pulling back a little bit, which is totally reasonable. But at this point, a chart like TROW may be one of the easiest names to trade or invest in, only because from a technical perspective, you have a clear illustration of a range, right? You have 220 just above there, maybe 225 as resistance. That's where we tested it in August and retested it in early November. On the lower end, we have this level from October around 190. This is also the 200-day moving average right around that point. So you have resistance that has been confirmed on the upside. You have support and moving average support at the downside. One of those is going to break, and that might be one of the most important charts to follow in financials, just to see which way this resolves. Do we get above 225? Do we get below 185? We'll call it. And either way, I wouldn't be surprised if the next leg sort of continues in direction of that breakout momentum. Now, you have other names in the financial sector that are in similar setups and or have broken out. CFG is another really interesting one because it's what we call a cup and handle pattern. Really isn't validated until you get above that rim of the cup, the neckline, which is right at 50. We're testing it today. I don't know if you can call it broken just yet, but I think that's a really important chart to maybe follow along with. CMA is another one, has already broken above resistance. Can't really call that a cup and handle pattern because it's skewing all to the upside, but this is a chart that's actually already broken to new highs. You also have Fifth Third, Zions. These are other ones that are just breaking above their highs from spring or early summer months, and I think those are important charts to maybe follow higher. Finally, I'm going to look at consumer staples. Now, I will tell you the average chart in consumer staples looks about this good, which is not good. Philip Morris is something that's rotating to the downside. It looks like the payment processors failing support, failing at moving averages. And overall, I see that as a chart in distribution mode. I would be inclined to wait until you see some signs of accumulation. Now, in the same sector, you have charts like Costco, which are, certainly look like they're in a different sector, just a nice, consistent outperformer. Looks like a technology name. You might guess this is Microsoft. When you look at the chart and see the consistent uptrend, the relative strength, it continues to improve over the last year. Decent chart and a nice run off of the March 2021 pullback in the case of Costco. But the charts I do want to focus on are things like Brown-Forman, which are actually more rotating to the upside. Ideally, I highlight a lot of charts that are already breaking out. Ideally, you can get into some of these names as they're rotating higher. And I see Brown-Forman making new swing highs, getting back above the 200-day, making higher lows. I find that to be kind of compelling. Constellation Brands is another one, kind of a distribution today, day to day. This is a bearish outside day, just like the S&P itself did, and overbought here. So certainly a chart to watch. This is as it's retesting previous resistance at 240, which is why it's an important chart to watch. Can it regain those highs and move higher? ADM is in the same sector. And in this case, as you can guess, be waiting to see improving, nice to see the rotation higher. I like that pattern, but I'd certainly want to see it validated by a break to new level of resistance. Church and Dwight may be the last one I would highlight in consumer staples with improving price and relative characteristics. I like the run off of the lows. It's in a basic pattern for quite some time. Getting above 90 was significant, getting above these highs from earlier in the year, and overall potentially setting up to go further to the upside. Those are just some of the charts that are top of mind. We don't have a ton of earnings this week, so for me, it's more of a technical exercise, and those are some of the names that came across my desk over the weekend and into today as I did the weekly review. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. I'm going to do the very played out, but still so fun methodology of doing the good, the bad, and the ugly. It's fun to take a particular sector or a particular space and think about which one's working. So I was looking at the Dow members when I came up with this idea because it certainly struck me. I was like, boy, there are just good charts and bad charts. And I was like, all right, I can find an ugly one. And we have all three covered. So good. It's charts like Home Depot. Now this closed at the lows of the day, a bit distributive in the short term, but overall, it's just a strong chart, right? New highs, higher lows, improving relative profile, which is what's most compelling. And home improvement retailers look a lot like this. Lowe's, very similar pattern, but also other names, things like TSCO and other names in consumer discretionary, auto parts, autos, to be honest with you, all looking fairly constructive with nice patterns. And regardless of the sector, regardless of the environment, names that are improving in price and relative strength, I think are worth paying attention to. The bad, we highlighted payment processors earlier in the show today. Visa is the one I'm highlighting, although PayPal might be my the other one to do. These are just bad charts, and I don't mean to make that label lightly. And this chart could certainly turn. This could be the low, 195. Write it down. This could be the end of it. But I'm much happier waiting for signs of accumulation. That's what I often mention, right? Buying something just because it's gone down a lot is never my favorite justification for a trade. Buying when something has changed from distributing, to accumulation, right? From going down to going up, then I think it's worth paying attention to. So I think with the payment processors, you look to see some sort of rotation, but I'm not a big fan of buying the falling knife type of approach where it's just rotating lower and breaking down through key support levels. I put a video on my YouTube channel called Market Misbehavior last week, particularly on Fibonacci retracements and Visa. Finally, the ugly. AT&T might be it, and this relative strength line is probably the most ugly part of this ugly chart. Overall, I think it's compelling because of a high dividend yield and the fact that it's extreme low levels. Again, I would be so much happier buying a chart that's rotating to the upside. That's what I would look for on AT&T. Folks, that's our show for today. Thank you so much for joining us every weekday after the close for the final bar. Again, we'll have a show tomorrow, and we'll take the rest of the week off for Thanksgiving. From everyone at StockCharts.com, I'm Dave Keller. Be safe. Have a great night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.